Hi, and welcome to today's Tax and Business Matters. I'm your host, Rachel Parker. Let's continue our discussion about capital gains tax rate for 2011. In the last segment, we have learned how to calculate capital gains or losses. Today, let us understand how capital gains are taxed. Capital gains are taxed differently, depending on what kind of capital asset you invested in, and depending on how long you held the asset. First, we'll discuss holding periods, and then look at different types of capital assets in the next segment. Alright, so let's begin. Capital gains are taxed differently, depending on whether your investment is considered a long-term or a short-term investment. The short-term holding period is 1 year or less. Short-term capital gains are taxed at ordinary rates. Meanwhile, the long-term holding period is more than 1 year. Long-term capital gains are taxed at discounted long-term capital gains rates. The long-term tax rate will be either 5% or 15%, depending on your marginal tax bracket. So you see, you can tell whether it is a short-term capital gain or a long-term capital gain because of its holding period. The holding period is determined from the date you bought your investment until the date you sold your investment. For example, Mary invests in XYZ stock on January 3, 2007. She sells the stock on January 3, 2008. Mary's holding period for the stock is exactly 1 year. This is a short-term investment. Let's change the example slightly. Mary invests in XYZ stock on January 3, 2007. She sells the stock on January 4, 2008 instead. Mary's holding period is 1 year and 1 day. This is now a long-term investment. Tax planning for investors focuses on deferring the sale of profitable investments until you qualify for the discounted long-term capital gains tax rate. So now you know how to tell whether it's a short-term or a long-term capital gain. Now, let's see how these are taxed. Capital gain income from assets held 1 year or less is taxed at the ordinary income tax rates in effect for the year, ranging from 10% to 35%. Next, tax rate on long-term capital gains. Capital gain income from assets held longer than 1 year are generally taxed at a special long-term capital gains rate. The rate that applies depends on which ordinary income tax bracket you fall under. 0% rate if your total income, including capital gain income, places you in a 10 or 15% tax brackets. 15% rate if your total income, including capital gain income, places you in the 25% tax bracket or higher. That's all for now. Now we have learned how capital gains are taxed according to holding period of the asset. Thanks for joining me in today's episode of Tax and Business Matters. Join me again next time as we continue to learn the basics on capital gains tax rate for 2011. In the next segment, we will see if capital gains are taxed, this time, depending on type of investment asset. You can visit us online at www.howtodooyourowntaxes.com. This is your host, Rachel Parker saying, the future you see is the future you get. Goodbye for now.